Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman and Wakefield's #1 investment sales team in New York City.
Hi, I'm John Hageman, partner at the Knakal Group at Cushman and Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of New York Investment Sales for Cushman and Wakefield. And today we're going to talk about the outlook for the 2016 investment sales market. So Bob, in our last episode we talked about the numbers for 2015, and at the end we talked about how going into this year it's the most challenging year to predict what's going to happen. Can you tell us about some of these challenges?
Mainly the challenges were trying to look at history and figure out where we're headed. I mean, our forecast for 2015 was almost spot on. We looked at 2014 in terms of a cyclical peak in number of properties sold, and we looked back at other years in which that was the case. We looked at 1988, we looked at 1998. We had different results after each of those peaks, but if we look at those peak years, we saw that the years following those peaks were also very, very solid, whether the market was going to keep running or the market was going to correct. So now the challenge was figuring out where we're headed in 16.
Bob, before you mentioned there were some stresses in the market at the end of 2015. Tell us what those were.
The stresses were that I felt that we saw finally a realization that property values had gotten so far ahead of fundamentals in New York that we started to see cracks emerging. For several months towards the end of the year, we saw land values falling very significantly, and not that those would be reflected in actual statistics. It's just that the offers that were coming in on land were sufficiently lower that it was not compelling for sellers to sell, so those transactions didn't happen. That's something that historically has been the case, is that you don't see these changes reflected in statistics right away. It's more a case of looking at what bids have been made on properties that give you an idea of what these changes are. We saw the hotel market similarly run into some issues. The hotel market has been very challenging of late. And so we looked at those two sectors, which are historically the two sectors that get impacted the first in a recovery, and that created some concern.
Bob, why are those two specific asset classes something that's affected first?
Well, for very good reason. One, with respect to land, land values are indicative of the perceived marketplace 2 or 3 years from today. So when a developer buys a property, they're trying to understand what they believe the market would be like 2 or 3 years from now, when that product will actually be delivered to the market. So that, more than anything else, is indicative of the optimism or pessimism that folks have looking at the market in the future. The hotel market reacts very quickly to changes in the market, whether those changes are actual or perceived, because leases are only for one day or for a few days, so the impact on the hotel market is immediate. There are other things that impact the hotel market also. The strength of the dollar has negatively impacted it. Airbnb has negatively impacted it. But if we look at changes in the market, shifts in the market over the long term, they've always been started by weakness in land and hotels.
But what about the other market segments?
We've seen multifamily properties hanging in there extremely well, and the same for office buildings. Multifamily buildings are historically the sector that will correct last. Rent regulation has a lot to do with that, and the limited downside that exists in regulated properties. The office market has done particularly well this time around, mainly because of the massive job creation that we've had in the city. We've had over 600,000 jobs created in New York City over the past 6 years. That has aided the fundamentals of the office market very significantly. So office is still doing very well, and retail properties are somewhere in the middle. As we sit here today in the beginning of March of 2016, retail assets are still selling for the same price that they've been selling for. There hasn't been any reduction in value yet, but the number of buyers for those assets is down very significantly. So that usually is a foreshadowing that there's about to be a shift in value.
Now that we're 2 months into the year, have we gained any more clarity on what we think this year is going to shake out to look like?
I think we have, Hags. I think that with respect to dollar volume, we're anticipating that dollar volume probably will be down 10 to 20% from what we saw last year, and the number of properties sold we think could be down as much as 30 or 40%. And while that sounds like a huge reduction, you have to take into consideration how elevated those numbers have been. The average number of properties sold in the city over the long term is around 2,700 to 3,000 properties a year. We've been over 5,000. So to have a very significant correction, 40% drop in the number of properties sold puts us right in the wheelhouse of the average. On the value front, I think it's very different. It's a little more opaque in terms of trying to figure out how much value is going to drop. We haven't formulated that. We do believe that average values will be down this year relative to next, and the extent to which is going to be dependent upon how several market factors play out.
Bob, what are some of those factors that are making it so challenging to understand how much the value is potentially going to decrease?
We're really in unprecedented times, Zags. We've seen things that are happening in our market that shouldn't happen. And a lot of it has been caused by the massive and unprecedented government intervention that we've had. We've never had a disruption in our marketplaces quite like this. And so we're seeing things happen that shouldn't be happening. We've had long-term U.S. debt downgraded, and yet interest rates, which should rise significantly under those circumstances, have dropped. We've seen nearly a quadrupling of our money supply, which should exert tremendous upward pressure on inflation, yet inflation is non-existent. So these are things that were generally accepted ways that the market would behave. They haven't followed those things. So while we look at the dynamics in the present market and say this looks, smells, and is acting just like a correction in the marketplace, it could play out very, very differently. So it's really making it challenging to figure out where the heck we're going.
So with all that being said, it sounds like it's going to be a very interesting year.
Well, put it this way. I'm happy that we're in New York City because of all the demand we have. Certainly, I think that our market will hang in there very well, but this could indeed be a very transitional year for our investment sales market. So in summary, 2016 has been an extremely difficult year to forecast for. We believe the dollar volume of sales will fall 10 to 20% this year, with a 30 to 40% drop in the number of properties sold. We expect values to decline on average this year from last, but the extent of that decline is very difficult to predict.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.